Hello, this is Tim Congdon, Chair of the Institute of International Monetary Research at the University of Buckingham. It's October 2024, and I'm busy at the moment preparing a lecture to give next month on the 18th of November at the Royal Automobile Club in London. I expect my lecture to be a turning point in the history of economic thought, and so I recommend that you come along and join the fun. What I'm going to do in my lecture is to reflect on the last 4 or 5 years of monetary events around the world, and in particular to explain why in 2020 I was right in my view on inflation, and practically the entirety of my profession of economists was wrong. I don't regard what I did as particularly extraordinary in any fundamental sense, because the ideas at work were pretty straightforward and simple. The puzzle here really is what on earth is going on in the economics profession. Anyway, let me proceed. In the weeks and months following the announcements of the COVID-19 pandemic medical emergency, the central banks and governments of the leading countries in the advanced world, not in the developing countries, in the advanced world, responded to the medical crisis by increasing their budget deficits, and then that's the case with governments, and then in the case of the central banks, they financed these deficits by issuing more money. And what the central banks also did was to worried about depression, and so they bought assets, they bought securities from the non-bank private sector, which increased the quantity of money. So it was already clear by late March, early April 2020 that this was going on, and going on in a big way. And so there's going to be a phase, perhaps only of a few months, perhaps of a few quarters, of rapid growth of the quantity of money broadly defined to include all bank deposits. I believe in the quantity theory of money. And if you get an acceleration in money growth of the kind that was clearly implied by the official announcements, you must expect some acceleration in inflation as well. And that view was reinforced by the fact that the effect of COVID on output would initially be unfavorable, and even in the medium and long run certainly couldn't be favorable. So you've got more money in the economy, and you've got, in the short run, certainly less output, which then means a faster rise in the price level, more inflation. Now, this was not the prevailing view among economists around the world. And I just want to quote now from 3 people of some importance in policymaking who, in my view, well, I think the quotations that I give will speak for themselves, show just how completely wrong these people were. But anyway, let me just first of all start with a chap called Olivier Blanchard, who's Professor of Economics at Harvard in the USA, and he had been chief economist at the International Monetary Fund between 2008 and 2015, and somebody, frankly, you would expect to know at least something about the quantity theory of money. This is something he wrote on the 24th of May 2020 for the Vox CEPR policy portal. You can still find it on the website, by the way. And his title was, "Is there deflation or inflation in our future?" May I just say, at the end of May, when this was written, it was already very clear that US broad money growth was way up into the teens in the relevant period and was going to carry on like that for some time. And what he said was, this is in the abstract of his, falling commodity prices, stumbling oil prices, these things all true at the time, and a depressed labour market will bring low inflation or perhaps even deflation, or will very large increases in fiscal deficits and central bank balance sheets bring inflation? So it's deflation against inflation. This column argues that it is hard to see strong demand leading to inflation. Precautionary saving is likely to play a lasting role, leading to low consumption, and uncertainty is likely to lead to low investment. The challenge for monetary and fiscal policy is thus likely to be to sustain demand, not to dampen down demand, to sustain demand and avoid deflation rather than the reverse. So this is Olivier Blanchard, a very prominent figure in American macroeconomics, at the end of May 2020. And more or less at the same time, there was a chap called Richard Clarida, who was at the time vice chair of the American Federal Reserve. And he said to the Economic Club of New York on the 21st of May 2020, this is again to quote, the COVID-19 contagion shock will be disinflationary, not just over the next few months, but over the next few years, meaning presumably not just 2021, but 2022, 23, perhaps 2024. Okay, that's from the American side of the Atlantic. Let's just now, I don't want to be too unfair to our American cousins, so let me now look at something said by a lady called Isabel Schnabel, who had been appointed to the European Central Bank's Governing Council in January 2020 and was the most senior German member there, apart from the Bundesbank's own representative. This is again 27th of June 2020. This is, as to me, the money numbers were already exploding. I hadn't been exploding for some months, and why I was at this time warning about inflation. This is what she says in a speech in Frankfurt. She's worried that the lockdowns and the restrictions and so on mean disinflation, depression, and so on. So, to quote, inflation could remain at close to 0% well into the next year, well into 2021, and even negative inflation rates are possible. In other words, there could be disinflation. Core inflation, which excludes food and energy prices, will remain below projections that we at the European Central Bank had made as recently as March, and will do so for a very long time. For a very long time, i.e. out into 2022, 23, 24. The Governing Council of the ECB unanimously agreed at its last meeting in early June that the danger of such low inflation taking hold and leading to lower wages, growth and investment was too high. Okay, well look, in practice we know that by late 2021 inflation was rising everywhere. Then of course we had the Russian invasion of the Ukraine. By summer and autumn of 2022, inflation numbers in the USA, the Eurozone, the UK, other places too, all around the world, all around the developed world, up into heading on towards double digits. They were the highest for 40 years. So these authorities, I suppose one calls them, these authorities were wrong in spades within about 18 months. I was right. And what I want to do today is simply to explain what I was doing. What I was doing wasn't very complicated. But you do have to believe in some theory. Now, the guts of my theory is, again, it's centuries old, is that people and companies, agents if you wish, they need to be in the private sector. I'm ignoring the government. They have what's called a stable demand to hold money. That means that they want to have a particular ratio of money balances relative to their incomes, also in fact to their wealth, but I don't want to go too much into that now, although it's very, very important. People, companies want to have a stable ratio of money to income. If, for whatever reason, there's a big jump or fall in the quantity of money, and the actual ratio is different from the ratio that they want, they will take decisions in the next few quarters, perhaps over a few years, to get back to the desired stable, relatively stable ratio that they really favour. And to me, this is the dominant driver of decisions on spending and also on portfolio decisions. This is really why in spring and summer of 2020, I was forecasting more inflation. So what I want to do now is just to show you the pictures for the USA, the Eurozone, and the UK. I welcome research from other countries. The quantity theory of money isn't always an everywhere theory, an always and everywhere theory. It's not something, you know, every country has its own different institutional idiosyncrasies. I know. Nevertheless, all economies have got money, all economies have got a price level, and in all economies, these are related. Okay, let's start off with the USA. So you see here the ratio of money. Well, it's the velocity of circulation, the ratio of money to GDP inverted, in fact, the velocity of circulation in the 2010s, finishing in the second quarter of 2020. You can see the stability through the 2010s. That was reflecting desired behavior. The economy was in more or less in kind of what I call monetary equilibrium. And then at the end, that plunge. So what I was doing in spring and summer of 2020 was warning that in the next, through 21, 22, maybe 23, and even 24, we would see that velocity of circulation rising back up towards the values that it had been in the 2010s. Okay, that then means that a rise in velocity is the same thing as money national income rising more than the quantity of money. 2020 was a presidential election year in the USA. I didn't expect the central bank or the government to do anything to really dampen down the quantity of money, and I was right about that. 2021 was the first year of the Biden presidency, and again, there was rather high money growth in practice. I didn't actually expect what happened, but let's come on to that now. This shows you the chart of velocity in the USA through to the second quarter of 2024. 4 years later. Now, look, we haven't quite got back to where we were on average in the 2010s. We've got pretty damn close. It's taken us 4 years, but it's come back to where I said it would do. And these processes do take 4 years. You know, my profession, so-called profession, often forecasts for next year or two. No, we want to think about the medium term. It's taken 4 years, roughly. Surprise to me, 2022 and 2023, we had virtually zero growth of money in the USA. I didn't expect that, by the way, in 2020. But what it meant was that we did have the burst of inflation, and then inflation came down. And so we're back now at the end of 2024 towards the 2% figure that the Federal Reserve regards as its kind of target. May I just say, before I finish on the USA, that when I saw these trends in spring of 2022, I said inflation would fall, and I said by the end of 2024 we could, well, the next presidential election, have an inflation number of about 2%, which is where we are. Always looking at the money number, always looking at the monetary trends. You know, one wonders what on earth these people, Blanchard and Schnabel, what they were thinking about, what they think about at all, frankly. Let's then look at the Eurozone. Now, the Eurozone is it's a single currency. It's been there now for almost 25 years. It's a fact. You know, obviously, in some sense, it's always been an experiment, but it's a fact. You've got all these different countries sharing a single currency. And when it first came in January 1999, it was a dramatic liberalization in some countries compared with what they had before. The banking systems were much freer to do what they wanted to do. They competed more. And that meant that for the economy as a whole, the desired ratio of money to national income, the equilibrium size of the banking system relative to the rest of the economy, was going to increase. So what you've had in the Eurozone for now quite a long-term trend is a rising ratio of money to GDP and a falling velocity. I've calculated an equation called a time trend equation for that. And this equation I've then used to predict what one would expect to happen to velocity in the middle of 2020 and the middle of 2024. Now, the next picture shows you what actually happened to velocity in the period running up to the middle of 2020. You can see the actual velocity more or less in line with that trend until we get to early 2020, and then this slump downwards. So again, it's not quite as extreme as in the USA, but you had excess money balances, velocity was too low relative to equilibrium, and one could again expect that velocity would rise over the next few years, meaning the next 3 or 4 years. So let's just look now at the actual behavior of velocity. You can see I've gone and put that trend line in. You can see velocity has risen sharply. It's actually gone a little bit above the trend line. Basically, my conjecture's been right. Okay. Again, in the Eurozone, from late 2022, much of 23, quantity of money wasn't growing, but we did have inflation jumping up to, in fact, over 10% in late 2022. I know the central bankers say that it was the Russian invasion of Ukraine that explained that. Let's just be clear that in the 6 months before the invasion of Ukraine, the consumer price index in the Eurozone rose by almost 3%, annualized rate of almost 6%. Sorry, this is not 0% of the numbers that Schnabel was talking about. This is what Schnabel was talking about. This is 6% before the invasion of Ukraine. May I also just say the energy price in Europe have slumped since 2022. The price level hasn't. Price levels kept on rising. And okay. So let's just finally look at the UK. You can see again the velocity through the 2010s, plunging in 2020. Now let's look at the number not to the end of 2020, but the end of 2024. You can see it's come back up, in fact, by about velocity come about 25%. Not quite where it was on average in the 2010s. It's about 3% less. By the way, there may be a good explanation for this, which is that at the moment, bank deposits are paying 3-4% because of the general rise in interest rates. So people want to hold a higher ratio of money to income, and that'll dampen down velocity. So we're not quite back to where we were in the 2010s, but we're not very far away. So what I've done in getting the view on inflation correct, all I've done is to apply the quantity theory of money and said that velocity will revert to its previous kind of average or typical kind of behavior. You may then wonder, well, how on earth was it that all of these people with all their degrees, all their qualifications, all their experience, how are they to get this wrong? Well, the question puzzles me too. Something is clearly the matter with the way that economics is taught and practiced, taught in universities, practiced in finance ministries and central banks. I will continue to argue the case for the importance of money in macroeconomic policy making, and I think what's happened in the last 4 years is an eloquent and absolutely crushing demonstration of the importance of the arguments I've been making. Thank you.